Hey guys, TommyBryson here, and what exactly happens if your stock goes bankrupt? By the way, the stock does not go bankrupt. In reality, the company goes bankrupt, which then means basically your shares go to zero, which basically means they're worthless, okay? That's the whole idea. But in this video, I'll break down exactly what happens. And by the way, guess what, okay? You have two types of bankruptcies usually that are going to be used here. Chapter 7 and also, for example, Chapter 11. Now, thankfully, I've invested into a Chapter 11 company, but also potentially a Chapter 7 company. I'll tell you all about it in this video right here. But by the way, I got very lucky with one that I got out very, very early. But the goal is, hey, what happens if the company goes bankrupt? What happens to my money? Do I get paid anything, okay? If they liquidate all the investors to sell them, like, hey, do I get a portion of that also? Okay, in this video, I'll go over everything, guys, okay? Now, if you guys are new here, I post videos every single day, so you should also subscribe and hit the bell to get notified. On top of that, also dismantle the like button, okay? That's the only way I know you like these videos. Now, the very first thing is this, guys, okay? Chapter 11 bankruptcy. What is it? Is it bad? Is it scary? Or is it really nothing? The idea is that yes, it is a point of, hey, I'm kind of worried here. And this basically means, hey, when a company is so much under pressure and has so much debt to the point where they have to go to court and say, hey, we want Chapter 11, which basically means we want to continue the business. However, we can't with everything that's going on right now. So how about you let us, for example, reorganize all this debt to be able to pay it off, for example, in a timely fashion, but not to the point where we basically cannot continue anymore, right? That's the idea. So basically, it's asking for a chance to make a payment schedule so things work out better for the company. Now, the idea is obvious, right? When this happens, shareholders get very, very worried, right? And so would I, so would you. Now, when this happens, basically, the stock price usually is going to go down, 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 because basically it screams out, hey, trouble, trouble, trouble. However, though, if this company comes out of this and says, hey, you know what? We paid off all our debts. We're no longer going through this whole thing. We're actually recovered. Then it's going to go back up, right? However, it could also happen that basically the company cannot recover and it goes bankrupt in full. And then you have a massive problem because basically your shares will become worthless, okay? That's the whole idea. So for example, okay, I invested into a company that had a Chapter 11 before. Well, really into an industry. And that industry was basically the airline industry. You know, back in May and also April, I bought Delta Airline, okay? And back during the pandemic, guess what? These companies were under a lot of pressure. They had no money, no customers, and a lot of debt, okay? They had that problem. So the big issue was, hey, do I buy this company was under stress or do I not buy it? Well, I went back and looked back, for example, what happened in the past when companies like this actually went bankrupt. The whole idea is usually they pick Chapter 11, basically saying, hey, we want to reorganize the debt and give us a chance to basically pay it off slowly. So I said, hey, if that's going to happen potentially, I'm going to go ahead and invest into Delta, which basically was a company I put money into. Now today, that made me around 100% of my money, which is great. But if it didn't go my way, potentially, they could have gone really bankrupt without the government's help. And then there could have been another issue because basically I would have lost a big chunk of all of my money, right? That would be a big problem for me, right? And also for you, if you ever buy a company hoping that basically, hey, they'll recover, but they don't. That's a problem. And by the way, whenever they're going through Chapter 11 bankruptcy, usually they stop all dividend payments because basically they can't afford it and they put that money to work towards paying off the debt that they actually have. That's the whole idea. So whenever you hear Chapter 11, don't get so scared, right? But understand basically the history and see exactly, can this company really recover? And what are the facts that lead you to believe that they actually can? That's the whole idea. It's basically restructuring the debt. That's what Chapter 11 is all about. So it's not like, hey, I'm gonna lose everything. It's more like, hey, I might lose everything, but I also might not, okay? That's the whole thing, but it's still very, very risky. Now I'm serious, okay? Now, on top of that, guys, I do wanna say one thing here. Liquidations are not always bad when it comes to a company, okay? Now, by the way, whenever a company liquidates, who gets paid first? Usually, it's bondholders, people that they actually owe money to. Secure first, and then unsecure next. Then it's going to be preferred stockholders. And then lastly is going to be common shareholders like you and I. So we get basically a lot of potential for growth, but also a lot of risk we take on, because basically when things go wrong, we take on the bulk of all the risk. Bondholders, not that much risk, and that's why they get paid first. And then second is preferred shareholders, and that's why lastly is going to be us. However, liquidations are not bad, because for example, back in the 1920s, for example, you can find a company that basically was selling for less money than was actually worth being sold. So for example, say you say, hey, this company is being sold for in the market for around 100 million. However, though, if I sold all this assets and so on, I could actually get, for example, 200 million. So people would go basically say, hey, I'm going to go ahead and buy a bunch of common shares of this company and potentially force liquidation. And when they sell, we all get a big payout, okay? That's what I did. Because the idea is that when it sells everything, right, you're supposed to get paid some money if there's actually money there. But when you have a bankruptcy, obviously, the creditors are going to get the bulk of the money, and that's why usually you're not going to get any money either, okay? The whole common shareholder usually is not going to get any money. And that's going to be the big risk you take on when you decide to buy a company as a common shareholder. Now, on top of that, you also have, for example, Chapter 7. And this is a whole different monster. This is the company saying, hey, I'm sorry, okay, we can't pay it. We're not going to continue here. We're done. Okay, we're donezo, okay? Basically saying, hey, all right, we're gonna have to liquidate. When they liquidate, the creditors are going to take a big chunk of all of that money. If anything is left over, which most likely there's not gonna be anything left over, obviously, right? Anything left over, preferred shareholders, and then finally common shareholders get some money. And there's usually not gonna be anything. And usually the stock price is going to go all the way down to zero, okay? And then at that point, it's just like, all right. And also it's going to be flagged saying, hey, this company is going through bankruptcy, which then means your shares are going to become very illiquid and very hard to actually get rid of. So keep that in mind also. So don't think, hey, this company's going bankrupt, I'm going to go ahead and invest for a discount. No, buying the dip when the company is worthless makes no sense. Okay, because the company is worthless. No matter how low you buy, the stock can go all the way to zero if the company is worth nothing. That's the core idea. And by the way, guys, the company I invested into that almost won Chapter 7 was this basically obesity company, and they had a bunch of lawsuits. They couldn't afford them. And basically, potentially, they might have gone bankrupt, but I got my money out early. I don't have to worry about that. But people that basically had that money in there, potentially, they lost everything. And that's the idea, okay? So just buying the dip is not enough. The company went down, oh, buy more, no. If the company sucks, you don't buy anymore, okay? So that's the idea, and that's why you want to be very careful whenever investing into a company. You know, that company, I put money into it. It was a big speculation. I made money, yes, but when that company shut down, I could have potentially also lost all my money, all right? So keep that in mind. Chapter 7 is no joke. The company is shutting down, boom, doors are closing. So overall for this video, whenever a company goes bankrupt, you know, Chapter 11, they can recover potentially, but they might not. But with Chapter 7, most likely, they're not going to recover. And you might want to get out as fast as possible. But sometimes they might even go ahead and remove from the stock exchange, and then you have to wait for liquidation and get your assets, well, get your money back potentially. Most likely, you won't get anything. And that is the risk of basically investing into companies. And that's why overall, guys, my advice is this, okay? Whenever investing into a company, understand companies can go bankrupt, make bad decisions, and potentially lose all your money. So be careful speculating and buying a company because basically everyone else is. Because when it goes bankrupt, potentially you can go ahead and lose all of your money. However, though, if you want to be a little bit more protected, you could always go ahead and, for example, invest into bonds into the company. So that way, if things do go bad, for example, okay, if I buy bonds for Apple, okay, and Apple goes bankrupt, really, I have not that much risk, right? Because basically, I'll get paid first before any of you do. Now, preferred shareholders get paid second, and then common shareholders get paid last. So by the point it gets to you, usually, you won't have that much money. And that's why the way I invest is through index funds and also ETFs. And overall, for this video, I'll tell you, okay? And the overall idea is this, okay, guys? Whenever I buy an index fund, I'm trying to track the overall market, okay? So I'm not worried about, hey, bankruptcies or anything going on, right? Because in reality, I'm tracking the overall market and I own a bunch of different companies in that whole like market, okay? And by the way, whenever one company goes bankrupt, another one moves in and basically things stay the same. That's why I invest the way I invest. However, if you want to pick stocks, if you want to pick companies, you got to remember you do run a risk. When you pick, for example, index funds, it's a lot more safer, and that's why the returns are not as high as, for example, with common stocks, okay? And by the way, the cool thing is this, right? The pro is common stocks can go all the way to zero, but they can go all the way up to who knows what. A share can go up to 1,000, 10,000, 200K, 300K. I think on Berkshire Hathaway right now it's around like 500 or 300K, something like that, or 400K. The answer is going to go higher and higher and higher and higher, right? But when you buy a bond, all you're going to get is that set interest. Preferred shares also have limiteds, okay? So the idea is that common shares are great, but they also take on risks. When you do index fund investing, they're great also, but you're just basically getting the average return every single year. And that's why it's a lot more safer, but the risk, because it's lower, the return is also going to be lower. That's the overall idea. If you want to invest the way I invest, link down below. ETFs and index funds, link down below with M1 Finance. If you want to pick stocks, I recommend 2 books. And the 2 books are basically The Intelligent Investor by Benjamin Graham and also Security and Analysis by Benjamin Graham and also David Down. By the way, Benjamin Graham was a teacher of Warren Buffett, one of the best stock pickers in history. That's the core idea. Guys, I'll see you guys tomorrow. Thanks for watching. Comment down below. Let me know if this video makes sense. If it didn't make sense, comment down below. Tell me it did not make sense. But if it did, like this video. On top of that, also, subscribe to the channel and hit the bell to get notified. And on top of that, follow me on Instagram, TommyBryson. And before I go, guys, I have 2 other channels where I post there every single day also. And links down below. And you can actually call me one-on-one and talk to me for 30 minutes for free about finance or any topic you want to talk about, okay? That's the core idea. Links down below. On top of that, I'll see you guys tomorrow. Thanks for watching, and as always, peace.